All right, everyone. Welcome once again to the Faces of Business. And do we have a special episode and guest for you today? None other than Andrew Krause, my partner in Exit Your Way. We're going to be talking today about the DIY business sale. For all of you business owners out there that want to understand and learn more about selling a business yourself, we're going to talk about some of the things and the steps you need to take to do that. So, Andrew, awesome having you here today, man.
Hey, good to see you.
Yep.
Hello,
Yep.
everybody. This is a really good topic, because I think one of the things that's understood about exiting a business is that it is possible to do it yourself.
Yeah.
You don't necessarily need us brokers involved.
Yeah.
We kind of talk a little bit about that today. Although I think most of the time it probably is good to have a broker involved, but
Yeah. There definitely are times. I mean, we talked about this over the years that we really wanted to create at least a guide of some sort for people that you can't help or that it isn't right, and to give them a little bit of information, and that's what we're hopefully going to do here today. Um so let's just get started, man. Selling a business. Let's talk about where do you think some of the times that selling a business could be appropriate for an owner to try to
um,
sell it yourself?
brokers, just like anything else, our fees are a lot, and if you're a small business, or you don't have anything particularly complicated about your business, then, it may not make sense to use a broker in the transaction necessarily. So,
Mm-hmm.
you know, um, although I will caveat that we can kind of run through how you do it. How do you
Yeah.
sell a business
Well,
on your own? It's really, we just can tell you because there's no secret sauce here.
no.
A lot of it's common sense, but it is a lot of work. And,
Yeah.
at the end of this, you can say, okay, well, I don't mind doing that, but it might make sense for me to get in touch with a broker and use them to do all this because it's just a lot of work.
Yeah. Well, and brokers, investment bankers are doing this stuff every day. They're doing this kind of thing, but there are times certainly when it is more appropriate, based on fees. Sometimes too, if it's a transaction to someone that, that it's, I should say, it's still a third party transactions, but if somebody really well and the terms and everything else, I mean, at some points it's just like maybe you want a lawyer to write up the documents and call it good.
Mm-hmm.
Uh, and
Yeah.
there's just times when it's a lot easier than it is. But if you're going out onto the open market, I think that to me, with a business of size, it is a differentiator,
Yeah.
and it kind of sets you apart. And you probably need to have help with it.
Yeah. And, especially too, it depends on what you're trying to achieve with
Yeah.
the transaction. If and that's one of the biggest obstacles for business owners is the lack of knowledge of what, how to value a business, what's the market like? What is the process for selling it? Because they're just, you know, there isn't a lot of information available to them. All you can see and really understand about business transactions or when they transfer is looking at public market.
Mm-hmm.
I mean, that happens every day. There's acquisitions, you have valuations done, share prices, price earnings ratios, but that has absolutely nothing to do with small businesses.
Yeah.
And the
Yeah.
majority of us are small businesses privately
Yeah.
held. So,
Yeah. Yeah.
and they're valued differently, and but there is a market for them, and it's I think people are generally aware of that. The business
Mm-hmm.
owners, there is a market to sell their business. I
Yeah.
think a lot of times, a lot of business owners go along thinking, I don't know, they don't really truly believe that somebody would actually buy their business.
Yeah. Yeah.
So,
Yeah, that's a good point. That's a good
yeah.
point. So as we start thinking about, I'm a business owner. I'm thinking, hey, maybe it's right for me to try to do this myself. So we start going through the process. What are some of the things I have to start thinking about?
Well, you have to think ahead of time. So, and understand that the process of selling business takes time.
Mm-hmm.
And you need to prepare for the sale, and prepare your business. No different than if you were selling your house.
Mm-hmm.
take a look. Hey, I'm thinking about selling the house, but we might need to do a little painting. We might need to do a little of this, a little of that, to stage it and get it ready to go to market. You need to do those things too. So, and understanding that is understanding about, what the buyers are looking for. Because now you're not selling your product or service anymore. You're selling a business, and that's a different ball game. You're probably used to selling your products and services and have been doing it for years, but it's a different customer now.
Yeah.
When it comes to this, and it's a one-shot deal typically.
Yeah, it's a good point, because the buyers of businesses have a much different viewpoint than the sellers that have been in that business for a long time.
Absolutely.
Yeah.
Yeah. I mean, and so that's some of the things. When you look at publicly traded companies, it's pretty easy to evaluate and establish what the market is for those. But when you look at small businesses with, maybe one owner, maybe a couple owners or partnerships, they don't have to, they can do their books or their financials their way. And they often do, but in public markets, they have to do them a certain standard way that everybody recognizes and understands as accepted principles. Otherwise, you don't know what's going on.
Yeah.
And you've got public people's money involved in that. So it's highly regulated and all that kind of stuff. But business owners can do whatever they want with their books, and often do.
Yeah.
That's fine. There's nothing wrong with that, running your business. If the books work for you and the way you do them, the financials, and you understand them, that's fine. But when you go to sell your business, if it's not recognizable to somebody on the outside.
That's a great point, because you can literally run your business out of a checkbook if you want, and do your taxes however the heck you have to do your taxes. And that's just fine for you. But when it goes time to show a potential buyer the performance of your business from a financial standpoint, they have to be able to easily understand it, and then also be able to make sure that whatever systems you have in place are going to be easy for them to take over.
Yeah. So, and 99% of the time when we work with a client, we spend a good deal of time before we put a business on the market, recasting, normalizing, and cleaning up financials, so that there is a good reporting mechanism for that is recognizable, basically, is what you have to get to.
Yeah. Yeah. I guess that's a good way to say it. Their financials have to be recognizable and easily understood, and also have to really pass the muster of not just the buyer, but maybe the buyer is going to have a CPA or another firm looking at the financials and the data behind it.
Absolutely. And that's the thing I think for anybody who wants to sell a business has to understand that, it's not just a buyer buying the business. There's a lot of stakeholders involved. Most likely they'll use a bank, and they'll get a loan. And so basically you have to also get through the bank. And so the deal has to make sense to them. And if you've got financials that have a lot of personal things or non-related business items that are run through there, which people do for tax purposes, then you got to clean those up and start doing that kind of stuff. So, and this is a thing that, again, plan ahead, because you can't change those things overnight. And, if you want to sell your business, you may want to reduce your income so you don't have to pay as much taxes over the years, but at the end, that'll cost you at the exit. So,
in selling your business,
less income shows less value in the company. And, so there's two different things that we have to look at. What the true cash flow is of the business and the tax cash flow are completely different things.
That's a great point, because if you're running a business and you're normally running it, I'm in the middle of my career and my business, I can try to reduce taxes as much as I can. But when you come to the end and the last 3 to 5 years of owning your business, you may want to not stick all those deductions into your business, or at least clarify which ones you're doing for tax purposes, which is legal to do, and which ones that are actual necessary business expenses, as I've heard you say many times.
We call that those are those are write-offs. I mean, let's
Yeah.
talk about what they are. But legitimate or not legitimate. If it's not legitimate, yeah, you definitely need to clean that up.
Yeah.
As a you get like I said, you're going to pay now or pay later. That's
Yeah. Yep. Yeah. In the last 3 years of owning your business, you definitely want to maximize your net income and the cash flow of the business to do it. I think and the other
those expenses are called discretionary.
yeah, there you go.
We call them discretionary because you may use them as a write-off. You may, for a good example, is you may write off in your business, you might write off your car as an automobile expense. It's totally legitimate, but in actuality, it's discretionary. Does that business really require a vehicle, right?
Yeah.
And if it doesn't, because what we want to do is we want to see the maximum amount of cash flow that comes from the business. So we want to, those discretionary expenses, we might want to add those back or reduce them so that the cash flow goes up. That's kind of how that works. So
yeah. So it's really important to understand your finances, get your financial information together, get it clear, get it concise, get it at least consistent so people can see it, because that's a big deal.
Yeah. And reconciled properly. If you do it yourself, or you get a good bookkeeper that does it on a regular basis, because everything needs to, buyers are going to come in and see financials, and it says you made this much money this month. They're going to want to make sure that goes back to the cash and it actually happened. And you can only, you got to balance the checkbook.
Yep. And even in bigger businesses that we sell, I mean, they go through the process of taking the cash from a sale to when it hits the bank, and counting the numbers that way, just to make sure that everything's flowing through like it should be. And actually, as they get bigger, it gets worse.
Yeah.
The scrutiny gets more.
And this isn't just something, when I say small businesses too, I have run across businesses that are 30, 40 million in revenue with 30 or 40 employees that don't reconcile.
Yeah.
And all it does, is eventually, if you make one mistake and miss a zero, you could be off your accounts by, builds over time.
Yeah.
It's just a good thing.
Yeah.
To get good in the practice of.
As we talk about preparing, I mean, we talked about the financials, and then you talk about taxes. This is something for some business people. There could be some back taxes. There could be some sales tax issues there, or, there's all kinds of things that happen, but it's not just anything with your income taxes has to be current, and you got to have them filed right and everything like that. And talk about that a little bit with taxes.
Yeah. I mean, if you go through a sale, you're going to have a or a transaction, and you can do that. And any good business attorney, or find an attorney that can handle that for you. We have people we work with all the time. That's the cost of doing a sale in a business that, and if you're doing it yourself, but they, all those guys will do their standard lien searches. Just like when you're also, again, buying a house or anything else, even a car, they're going to make sure there's no liens and titles are free and that kind of stuff. And there's things back there. So a lot of times we run into the end of the deal. We try to do that ahead of time before we get started to make sure we'll get through. Costs a little bit of money, but it's not that hard to do. And you've got to watch out for hidden those. I mean, a lot of times there's stuff back there that they weren't even aware of.
Yeah. It could be a tax problem from a long time ago. They didn't even realize or got missed, whatever it is.
Didn't get filed, at the county register. Those kind of things happen all the time. And sometimes there's stuff sitting on there, and it's sometimes you can, it doesn't mean you can't do a deal, but it stalls, and then you've got to go clean all that stuff up.
And some of that can take quite a while to do. And when you're at that point, it's much easier to do that stuff ahead of time and have it done ahead of time.
Yeah. And then, your business, the buyers who are coming in to look at a business know that you prepared well for this, those kind of things. So.
That is, and that's one thing to think about when you have you are better prepared and organized. That will get deals done faster, don't you think? Because the buyers see that you've got your, poop in a group sort of.
Yeah, faster, or just get the deal done, period. So
Yeah.
that's really what you're facing in a lot of these situations. It isn't a matter of, how long it'll take. It's, you got to get over these hurdles to get a deal done and get across the finish line. So you got to meet these requirements.
Yeah. Yeah. That's a good point. I'm going to write hurdles down because we can talk about that, because there's some big ones in here as you run through it. So, and then when you're okay, so you're prepared for the business and you've got your taxes cleaned up, and there's some other things too. I mean, we've run into environmental issues or workers' compensation kind of things. All that stuff has to be addressed before you go into that.
Mm-hmm. Absolutely. And then really the next step is, pricing.
Yeah. That comes down
what you want for your business. Cause like I said, you don't need a broker if you got a number that makes sense. And you can go to market, you can go make a deal with anybody. You don't even need to go to market. You can, and that kind of stuff. But you really have to understand, number one reason a business doesn't sell is because it's pricing. It's a very sensitive market price. And if you're too high, it's just going to sit there.
Yeah. Yeah. And this is a common fallacy, I think, and correct me if I'm wrong, but what if a business is priced too high? Do people come in and offer lower prices, or what when they do that? If it's priced too high, what happens?
Nothing. They don't.
Okay.
Yeah, they didn't realize, and I think most cases too. I mean, we try to be proactive to talk to them about that. What's the reason you're passing on this deal? Why don't you want to buy it? And sellers are often reluctant to do that. But if they see that the price is that much out of whack, it's not, for them, they just move on.
Yeah.
They make the assumption you're really not ready to sell. But the other factor is too, and especially with small businesses, that buyers are not as sophisticated in a small deal on that side, so they don't know how to value it either. So so you've got that problem. But I think if you're going to do it yourself, get a third party to come in and do a valuation.
Yeah, well,
you should be able to get that. That's another part about being prepared and going through the process of getting a formal valuation. A market. I mean, there's all kinds of valuations, and there's a lot of people that can do that kind of work, and we do that for clients as well. We'll go in and give them valuations for a lot of different reasons, but if just a market, you're trying to find your probable selling price, right?
Yeah.
And a good valuator can help you do that, and then you'll have that as a basis for negotiating a deal that makes sense.
Yes. And one of the things I think that is good about somehow determining the right an appropriate value for their business is that a buyer can say they're going to pay whatever, and as you said a little while ago, the banker is often the one that's going to say, well, I can only loan so much money on this transaction. If I'm using the SBA, for example, if you're under $5 million of transaction size, they have requirements that each bank has how much they'll loan based on the cash flow of the business. And it doesn't matter what the buyer says unless the buyer is willing to make up the difference in cash.
Yeah. And that's usually not the case.
Yes.
I mean, if you can't get a loan approved, on this, it's telling you something, and they have their formulas. So another good thing to do if to sell the company on your own, get a valuation done, go to a bank, talk to your bank and say, you know what, I want to sell my business. What do you think? Would you lend money to this if I find a qualified buyer? And they'll run you through it, and then it's really a good check on, hey, I'm definitely confident in what I can ask for this business. For them, their way of looking at it is debt coverage, and it's and they do the same thing when you apply for a loan for your house. They want to know what your income is. They look at everything because you have to have enough cash flow to cover the debt service. Now, buyers looking at a multiple of earnings and, those kind of things as far as projections go. So they value it on a different way, but the market sets in. But at the end of the day, if there's not enough cash flow that runs through that business to pay that debt service off, you're at that price that you're asking for, what the bank is lending it for, then you're too high. So it's not rocket science necessarily, but this isn't. The deal needs to make sense. The numbers need to make sense economically. And any broker that tells you we'll come in and get some knockout number for you, it doesn't work that way. Like I said, a very price sensitive market, and it is what it is. So you have to
math.
Yep, it is math, and you have to really take the emotion out of that, because I know that I've dealt with a lot of clients and it's disappointing. But, and another good practice too is maybe you're years and years away from thinking about selling, like I said, plan ahead, but, spend the money to do an evaluation annually.
Yeah.
And it's a good metric to see how your performance, see how you're doing. And it's also something that you can provide, to a buyer when you go to say, hey, I do this annually. It's part of my process. It's our review, and it's how you develop your strategy going forward. So, because what that'll do is also bring up areas that, weaknesses that you need to address in order to get business going through that process.
Yeah, because a good valuation doesn't just go, okay, here's the numbers. They talk about management team. It talks about market. It talks about, your customer concentration, a lot of other things. You're putting your information in on a free market or free business valuator online is not going to get you.
Yeah, just be careful of that. They're not cheap. Even just for on a market valuation, a good one to give you a good, market rate, a value is, $5,000 to $10,000, depending on the complexity or the size of your business. So, and you should, don't cheap up on that, because the run of them are just running formulas through, and it's a numbers thing, and it's not the same thing.
But understanding that value and valuing it appropriately on the sale it will do two things. One, if you are going to get offers, you're going to get offers if it's priced right. And two, it will keep you from a long time disappointment, because if you've got your business priced wrong, too high, and it could sit on the market for months and months and months and months, and you're just disappointed because you don't know why it's not moving, why you aren't getting inquiries on your business, and it's around price.
You
just won't get any action on it at all. So.
And that's the thing about valuations, is they change. Your value today in 6 months from now can be drastically different. So it's good to go back and re-look at it too. But and one of the things about evaluation too is on that sales prices. In a transaction, that may be what the number is, but it doesn't mean that's what you're going to get. So you do have to figure that out too. Because then you know what to build for if you want to try and sell your business for.
That's a good point, and I think that this is probably the proper time to talk about that, because if you sell a business for $1 million, that the total price for the business is $1 million, you don't walk away with $1 million.
Yeah, I mean, this is typically these are asset sales most of the time, and they're going to buy the assets of the business, not the liabilities. They're going to want to have working capital provided, which would be included in the sales price. They're going to want, they're going to want, they may want you to sell or finance a portion of it. Rarely do you get all cash offers unless you have something very specific that they need, or some intellectual property, where you get into that kind of thing. But you read about those, in the tech industries, tech space, particularly the big cash sales and stuff like that. But typically, the banks also on these small business loans require seller financing, so it's virtually a fact of life. But you can figure out ahead of time what your commitment would be to that, what you're going to have to do. And then, yeah, even if you have a $10 million sale on a company and the taxes come out of it, they have a holdback note. You don't get your receivables. they keep those because that's the working capital, maybe some cash in the business. And then, at the end at closing, you're getting $4.5 million.
Yeah. Yeah. It just depends, because you could easily on that, if you had capital gains tax on the full 10 million, that would be 2 million or close to it now.
State capital gains tax.
Say if they got state capital gains, it could add more to that. And then you're going to have to pay down any debt, because it's going to be a debt-free sale. So if you've got $1 million on the books and debt, so you drop another $1 million, and then you seller finance 25% of it. That's another $2.5 million that you don't get at that time. You'll get paid over time. It comes down to a lot lower number at the day of the close pretty quickly.
Yeah. And don't worry about that, but just knowledge is power. Know it.
Yeah.
Figure out what the number is, what the proceeds are from it. And you're going to expect to get some payment over time.
Yes.
And the value of the business, or that number at the beginning, is, the terms are everything about it. It's not the number. And, when that number covers in your value of the company, you get more money. If you sell it for all cash, all buyers who say, hey, I'll offer you cash, but it's usually a lot less, right? But if you're willing to sell or finance it, you'll get more money. It might take longer to do it. And when we talk about earnouts too, earnouts are, based on the future performance of the company. That means you're staying on potentially and trying to see it through. If you're selling based on growth and projections into the future, sellers generally won't pay for that.
The buyers will, if you said you can grow it this much, and they may include an earnout, want you to be around to keep the business growing like that.
Right. So if you meet the projections you claimed, that we're going to be there for next year, see it through, then you get X amount of dollars and negotiate those kind of things. I don't, if you're doing this yourself,
that'd be a pretty tough one to do.
I would stay away from that. Nobody likes it, but that is a way. If you're comfortable with it, that's an opportunity. And also you have the energy to stay in the business and work on it. You have the, you could have the ability to get a premium or get more money on it.
Get a bit more money. Yeah. Because you're being flexible on the terms, like you said.
Yeah. It's not like a loss thing, if it doesn't hit the targets, then you don't get paid. It doesn't like they claw, buyers don't typically want to go back and claw back money out of it. If you meet those targets, they have to assume that risk. So,
Yeah. So when you talk about selling a business, the other thing that comes up is confidentiality.
Yes.
So talk a little bit about that and why that's important.
Yeah. I mean, confidentiality, that's, we represent our clients, and that's a major, function that we have to, it's part of our DNA is to be confidential. And it's a silly concept because you've got to keep everything secret. But how do you sell something if you can't tell anybody about it?
Yeah.
Well, but there is a way, there's a process for doing it, but you don't want, it's disruptive. The minute somebody knows business is going for sale, your employees tend to freak out. Your customers tend to freak out. Your competitors start to get nosy and want to poke around and see what's going on. Also will, disparage you to your clients. And it's a tough world out there, but that's, they're going to negatively recruit. That's for sure when they're out there selling. So, so for the most part, and some people have different thresholds. Some people want it completely confidential and nobody to know that I'm going towards an exit. And you got other people whose threshold's not that high. I don't care. You can tell it's for sale, and that's fine. I recommend that you keep it confidential, even if you have a low threshold for it.
Yeah.
Because it's nobody's business. And also, and I think, psychologically it works as well. In order to sell your business, you're going to have to open up your very confidential information. You're going to show them your business plan. It's your intellectual property. It's the thing that's been making money. You don't want everybody in their brother looking at it. You want qualified people who, are qualified buyers, either financially and professionally as well. You might have buyers who come in and we do this all the time. We screen that, come in and they may have PhDs, and have all the money, but this is, this business is functioning around sales. That's what you need your thing is. So, it's not a fit. And, you can, with all good intentions, they may have all the money there and they want to buy the business, but going through diligence and all the way down to closing, at some point, even somebody's going to go figure out, I have no idea how to do this. And so, it just ends up wasting your time.
Yeah. Yep. Good point. So in the confidentiality, I mean, it really is pretty simple. You're going to see this when you look at businesses. There is the executive summary that you normally create for a business sale. That is the nondescript, kind of gives you numbers, tells you an industry kind of thing, and you can see those in a lot of places. And then once you get into the more detailed information, you're going to have to provide a lot more after that for those buyers, for sure.
Mm-hmm. Yeah, marketing package. It's. That's what we do to sell a business. Is you got to put together marketing materials to sell your business. Your valuation is a section of that. We'll provide data into that because that's the financial reason for buying this business. But again, what do buyers buy? And then, you start out with an executive summary that's an overview, and it's one page, and it tells you the basics, on that. And then you go into, but they're going to want to know, your employees, who they are, what their qualifications are, how long they've been there, the team, the equipment, if you have it, if you're in that kind of business, have what's up to date, what's your technology stack, what's your sales strategy, what are your projections, what's the assumptions or basis for all those, all that's included in is who your customers are, what your customer mix is.
Yeah.
It's a business plan.
Yeah.
Fundamentally, but it's, geared towards more, supporting an asking price.
Yeah. Yep.
And
there you go.
Even very large businesses, but privately held business owners, they don't have to do business plans, and many of them don't.
Yeah.
And that's fine.
Yeah.
But in order to sell a business, you kind of have to put it down on paper so you can show the buyer. It's a playbook. Hey.
Yeah,
give me your check, and I'll give you the keys. And this is the playbook. This is how you run the business.
Yeah. And that's a good way to describe that detailed document that has to have virtually everything about your business that someone would want to know, because they're going to use that in the initial phase of looking at your business to make a determination whether or not they want to put an offer in on your business.
Getting And the bank too, that's something that you can preview with the bank to say, hey, would they be able to fund this? Getting pre-qualified in a way for that. That's what that process is. And that's excellent to do that ahead of time. That'll really help you sell your business, make it easy for the buyer, because you don't, it's not like they know what to do necessarily. A lot of the times it's their first transaction like this as well. And like I said, we do a lot of educating to try and help them. Yep, this is what you need to do. Go to the bank. This is what you're going to need to qualify.
Yeah.
So they understand that. That takes time, and if you do that ahead of time, you're really ahead of the game.
Yeah, for the smaller business buyer, definitely there's some first-time buyers in there. There are going to be a lot of first-time buyers. Even in some of the multi-million-dollar transactions, there's first-time buyers in there that may or may not have already established their SBA connection or whatever banking connection they're going to use to buy their business. And it is helpful to have that shown as a seller. You can show it to the bank and get it pre-approved to a certain extent for the right buyers. And it is a really good thing to do. So let's talk about buyers, because I think that's one of the things that someone that's selling their own business is going to stumble on right away. And because it's you want to talk to all these people but there's a process to do it. There's steps that you should take. So talk a little bit about that, because you can spend a lot of time on someone that is never going to buy your business.
Yeah. I mean, if you've done all the cleanup work and you've got the materials prepared and you're ready to go to market, you can approach a buyer from anywhere. And you need to think about who is the buyer. What kind of person would buy my company? Do they need particular professional skills and background, as well as the money? Obviously, everybody needs to be financially capable.
Yeah.
At that point, but could it be a competitor? Could it be somebody in a similar business that would help them, vertically integrate? And the deal about this is that they often don't have an acquisition strategy like big companies do. So publicly traded companies, they have entire departments that their sole focus is just buying up other companies. That's how they grow. That's how they increase shareholder value. And
yes.
So it's not impossible, but again, if you've prepared well for it, we spend a bit of time trying to convince buyers to look at this opportunity, and because of what that potential and what that'll do to their business strategically. So but there's all kinds. Buyers are generally there's individual buyers too, that somebody who wants to be an owner or operator, has specific skill sets. Has the financial capability to do it. Maybe worked in, corporate or something, and wants to get out and be an entrepreneur. Those are good buyers. They don't typically pay as highly as strategic buyers, but that solves a lot of problems, especially if you're exiting the business, because they're going to work in it, and they're bankable. But they can go to the SBA. Oops, what did I hear? Then. And then the other kind of buyers then are investor buyers, like private equity groups, family offices. You probably read about these guys all the time, because they're buying up companies more and more. They raise funds and have committed capital. And as like we talked about with the bank relationship too, is that a lot of times those guys, they don't come in with bank relationships. They shop these deals to the banks. They're looking for the absolute best rates and terms they can get. So those are professional buyers. And they've raised funds from investors that back them on it.
And the one thing that I don't think people really quite understand about an investment buyer is, if your business is the right size and investment buyers are interested, they're really constrained on what they can do from a buyer's perspective by what they told their investors, what they're going to invest in, the kind of terms they can do. There's a lot of specificity around what they've told their investors that they have to do when they're making investments.
Yeah. Well, there is also, they have, and they'll talk to you. I mean, if you have a business and you want to talk to an equity buyer, but they'll give you they're good buyers. They'll give you a detailed profile about what they're looking for, what industries they want to buy a company in, what size they're looking for. They do have thresholds, so, if you're a really small business, you're not going to, it costs them too much to process a transaction that they wouldn't be interested. Although, they do what they call tuck-in. Basically, they may have, if you're in healthcare, for example, and you have a small healthcare company, they would buy you as an add-on acquisition to their existing entity. So they will take smaller deals to do that necessarily, but you don't get the money there in those transactions that you would. And size matters.
Size matters in a business sale. That's correct. And a lot of people don't realize that as your dollars of revenue and profit go up, you get more per dollar of profit in value when you sell it. So, a $5 million business, per dollar of profit is worth much less than a $15 million or $50 million business, and the profits they generate from that same business.
It's called a size premium. Businesses, the larger businesses are perceived as more stable, to investors, and the market is they get a lot more money in obviously the biggest companies. And that's why it's very difficult it's really apples and oranges. Don't look at a publicly traded company. You read the news that's trading at 25 price earnings ratio. It has nothing to do with the small business. You're not even close.
Yeah. That's a good point. Public company values are way, way higher, and it is the size premium, and also because they are public and the things they have to go
Yeah.
through to report their earnings and everything
Yeah.
else.
Yeah.
Financial stuff.
Yeah.
So,
but I say that it's important because owners look at those big numbers and they think that it translates to theirs, and that's where a lot of that disappointment comes from when you find out what the actual value is. And our value in small business world is the cash flow that supports the debt service. It's, that also, builds equity in the company. So it's common sense, but eventually a person who buys a small business is going to want to own it, and the business will pay for, the cash he brought for that business over a reasonable amount of time, 3 years, 5 years, those kind of things. And that's where you come up with the number.
Yeah. So now you're doing this, you market your business, you found a good buyer, they're going to submit an offer, a letter of intent. And now to the first time business seller, they're going to say, whew, I'm almost home.
Mm-hmm.
Tell us about what this really means when you get this offer, this letter.
Yeah, I think that's the objective. When you put your business up for sale on the market, you got your package together, you're going out there, you're presenting it to people. The objective is to get an LOI. It's non-binding, but it could be, but it's basically what the buyer gets out of it is, hey, it has to describe, hey, we agree with the asking price. Here's what we're offering. Here's how we're going to finance it. Based on the information you provided so far. And then, we're going to make this agreement to now go into diligence, which is after the LOI is signed and in closing. What the buyer gets out of it is exclusive dealing, which is basically, yes, we've agreed we're going to sell you the price based on this. We can all back out at any time based on what we might find in further diligence. And it's just like when you sell a house too. You can get the earnest money in on a deposit, you get a LOI, but then the home inspector's got to come and make sure that we don't have a toxic waste dump in the backyard. So,
well, and that's true, and that's where once you get that letter of intent, it really just starts your due diligence period for the buyer to really do a deep dive into your business.
Yeah, and due diligence is like we've given them a book here that they base their offer on, and they read it, and it says, it says what your cash flow was, historically and all this stuff, and what it's going to be going into the future. You can write anything you want on those reports, but diligence is there to verify that it's actually true.
Yeah.
And the buyer should, again, qualifying a buyer should be, professional, that they bring in a proper group. Either they have a CPA or they hire a CPA to come in and do not a full audit, but at least, to go and look at everything and verify that everything that we presented in that offering is true.
Yeah. Yep. Because they're going to, at the very least, take a look at tax records, go from bank statements, so they see the money coming in from a customer and going through tax records and everything else to make sure that it all and it all balances out.
Yeah.
I don't know a better way to say it, but that's what a lot of the diligence is. They might talk to customers, they might talk to suppliers, they might, they might want to inspect equipment in some cases.
Yeah. They'll want to review contracts.
Yeah,
you have all your contracts, and that service contracts with vendors that you use, employee contracts, customer
leases.
Contracts, of course. Obviously, that's the time when they're going to want to review all that, because there are things in there that would prevent a sale, and again, those things you should review ahead of time and have them ready for the buyers to go and do that and review them yourself to make sure, is there anything in here that's something that would stop a deal from happening?
Yeah. That's a good point. That review and preparation for diligence is one of the things I think as a do-it-yourself or business sale person trying to sell it yourself is really preparing more for that ahead of time will save you a lot of headache later.
Mm-hmm.
Yeah. So they get to the due diligence. We're getting down to the end now. And we talk about the purchase and sale agreement. So what's this doing?
Yeah. Well, that's the next step in the process. And actually, I think there's some very good websites you can go to too that will show you all the documents you need, legal documents you need to go from selling a business all the way through closing. I don't know, LOI, and some of them you don't need necessarily, but a purchase sale agreement is, that's part of the, that next step in the diligence is usually there's contingencies on the offer. And one of them is that you've got to come up with a purchase sale agreement, and you go back and forth on that. And if you can't get one that's agreeable to both of you, then your deal's not going to get there. But that's when you go to the escrow office and get the closing attorney, to write up the purchase sale agreement, and then you're going to go and close. And you get a check.
Yeah, and the purchase and sale agreement, though, that is the details. That is this is where the money's going. This is where, if you're going to pay off your, you got equipment that you got to pay off beforehand. If you're going to keep a car, or what assets you're transferring with the business, what assets you're keeping, all that stuff is in the purchase and sale agreement. So it's an extensive document.
Yeah.
And you need it. Yeah. Because it'll spell out that if you're going to have seller financing, and we'll talk about that, you'll probably have a separate, some sort of promissory note for the seller financing, but this is going to say you're going to get paid this amount of money in total, but you're going to get paid this much at the close, minus this much for these taxes, minus this much for the debt, minus this much for this and that. And this is how much you're and seller financing, whatever the heck else.
And don't forget reps and warranties.
Yeah. And
that's often a scary proposition for a buyer to understand and get around. And attorneys will try to help you. It's normal. But they don't, you're going to have to provide warranties and representations around the business, mostly around, hidden liabilities. There was a tax bill that wasn't uncovered, a lawsuit that comes up after the sale that was on your watch. Those kind of things, they don't leave. It's always a business risk. You're in business, you're going to always have those risks, but and then they're put in there to protect the buyer from inheriting those necessarily. So
it's a good point. That's a good point. But that purchase and sale agreement, I mean, you can spend a significant amount of time, and it's usually done by lawyers, so a significant amount of money. If you don't have a good idea of what you are going to do ahead of time, and then just depending on the negotiation and how it's done, and you got to get it done.
You definitely save a little money by there are purchase sale agreements, standardized ones that are used by at least in Washington State. I'm aware of, and I think every state, even through the MLS or the real estate commissions, they have kind of standardized forms.
Yeah, so you can start with at least.
Has a lot of the reps and warranties already built in, and
it could be appropriate for the do-it-yourself kind of seller. Yeah, and then when it comes down to the closing, you talked about this a while ago, because I think this is where you kind of go, okay, we agreed that we're gonna sell them the business, and we're gonna close the sale of the business, and that's a good day because everybody gets paid, or everybody gets a business, or they get paid. But there is a lot to that day. And what people don't realize is that closing process is usually done by a closing agent attorney. And walk us through that a little bit and what they're doing there at that thing.
So once you got your LOI signed and you're going into diligence, you're preparing your purchase sale agreement back and forth between the buyer and seller and your counsel. There are, and it's even affordable as escrow. There's escrow attorneys that will handle that process for you. They are attorneys and they do all the documentation, stuff like that, but they don't represent you, the buyer or seller. Typically it's reasonable to split the cost of that with the seller. But they'll walk you through the whole thing and everything that you need. And basically they do lien searches and they clear the titles and they pull in all the documents that you need, a bill of sale. And then, when they show up to closing, they got a big, well, nowadays you can do it virtually, but we used to show up with a big bag and you sit at a table and it's a couple hours of going through a lot of documents to sign and review. And even then at that time, you may have to run out and go find something that was missing or overlooked.
But
because they guide you through that, all the things that need to be addressed and signed.
Yeah, and it is, and there's a lot of little things too when you look at some of the things like transfer of a building lease.
Yeah, vehicles, are involved in the transaction. If you got delivery vehicles, titles have to be transferred, taxes have to be paid. And those kind of things, and they handle that. Escrow handles that.
Yeah, they calculate all the amounts and just make sure it's taken out of the proceeds appropriately and file the right stuff with the state and federal government for that transaction. I mean, there's a lot of work that they do, and it's a step that I don't think as a do-it-yourself business owner you would ever want to try, because it's not that expensive and you can get in a lot of trouble if you don't do.
Yeah, the only advice is just don't go to a law firm to do it. They can do it.
Yeah,
but go to an escrow firm that does that. It's a lot cheaper, and they know exactly what they're doing. So they do transactions all the time.
They'll get done. And so when we're doing this, I think we kind of walk through the process. You got to prepare for the sale. You got to understand the value. Think about the confidentiality. Put together that marketing package.
Well, at closing too, that makes me think about too. Don't forget your corporate documents, your registrations, your state registrations, your federal business licenses that you have, and if you're in different counties and cities, you have them there too. Double check on those. Many business owners get incorporate, have an accountant set them up in business and stuff like that, and then they throw those. You're supposed to do meeting minutes and you're supposed to keep those things up every year. They throw them on a shelf and never look at them again, which is fine until it's time to sell the company, because the escrow attorney is going to want to see that all your registrations are up to date, all your meeting minutes have been done, which is, in a small business, a meeting minutes is, it's a note to yourself, and you file it with the state, and then you got to make sure you stay up on your state licenses and registrations too.
Because they will check all that. It all gets checked.
And because we'll find out at closing. We didn't pay our annual registration fee with the county or something. And we've been through this where you go down to the courthouse and you get it done.
Those kind of things happen, and that's why that is also too. You mentioned this escrow agent to help close the sale of a business in a DIY situation. Even in where professional buyers are doing it, they still use those same kind of people, because there's a lot of details in it, and it's well worth it to do that. Good. So when you look at the process, and we'll run through a real summary real quick, but what do you think would be the toughest thing about selling a business yourself?
I think really it's emotional. And I think we exist as an industry as intermediaries, business intermediaries, to get between the buyer and seller. When you're negotiating the sale of your business, it can, it's very difficult to not take it personally. Buyers, are going to say things, and their job is to get it for the lowest price possible. Their job is to get the most. So it's difficult to navigate through that, but I mean, it can be done. You just have to, you have to get the emotion out of it and recognize and understand that knowledge is what frees you up. Getting a good valuation, knowing what your number is, managing your expectations on this deal. And if you're happy with that, then go ahead and get it done, and listen to the market, because if it's not happening, most likely it's because you're either asking too much or you have different expectations about that. So if you can get around that, You know,
Good.
like I said, then it's just following the process.
Yeah. Yeah. Well, I'm going to run through the process real quick, a quick summary, and then I think and then we're going to wrap it up here, Andrew. But really, we talked about preparing for the sale and some of the steps. We talked about getting the valuation and evaluating your business, the importance of confidentiality, and then we talked a bit about the executive summaries and confidential information memorandum, SIMs, people call them, which explains your business, and then marketing the business for sale and talking about buyers and qualifying buyers and types of buyers. And then working through, once you get all that way down there and you're talking to buyers, to the letter of intent, where someone actually makes an offer on your business and some of the details of that. Then the due diligence period, where they can come in and look at all the information and verify that what you said in the documents you provided is accurate to the best they can do. Then the purchase and sale agreement detailing where all the money's going, where the details of the purchase. And when you sign it as the seller, you're going to sign that, yep, what I said was right. And they're going to sign, and then you've agreed on when you're going to do it. Then we go into the final thing of closing the sale, and that's when the escrow people or whoever's doing it checks, like we said, all the taxes, all the registrations for vehicles and leases and anything else. Everything is paid down to the day that you owned it as the seller, and as the buyer buys it and makes the money transfers everywhere it needs to go.
Yep. Yeah. I think the only thing I would add to that is it doesn't end there typically, at closing. So, there's typically, transition is a big thing. You want to make it a successful transition, and it is typically, it is expected that from the market that you would stay on for a reasonable amount of time, and not just something you need to get detailed out in the offer. Is how much time you need. All you need to do is, if it's on a consultative basis or if it's maintaining, customers through the transition, you'd really need to identify, what is the basic minimum you need to do to help make it a successful transaction. That's it.
Yeah.
Don't go beyond that, because you don't want to be an employee.
Yeah. That's a great point, because I got to say that most people, when they come to us and start talking about it, they say, well, I'd be available for a year or something like that. And it's usually
60,
90 days. And then it's part-time after the first couple of weeks. And it trails off pretty quickly, because that new owner, honestly,
that always depends. I mean, it could be a very complex business that really needs you to help, and maybe you need to be on there for that long a time.
Yeah.
But generally 60, 90 days, turn the keys over, drive them around the block and let them go. And then you just go back and, hey, here's my phone number and I'm available anytime to help.
Yep.
So, and they will do that, but you don't want to end up working in the business unless you have a contract to do that. It's something you want to do.
Because we've been involved in those too, when the owner stays on for a while as an employee, and that works out sometimes it doesn't so well, and it's one of those things.
You just want to get them on, because they're going to have their own ideas. They're going to do things different, and you just want to show them how you do it, and then let them go on from there.
That's the cleanest way to do it, for sure. All right. Well, Andrew, thanks so much. I mean, we wanted to talk today about the DIY business sale. I think we've covered a lot of the points there. We'll make sure to put the links to more of the articles that we shared in the comments here. But thanks so much for being here. Thanks so much for listening today, everyone. And we will be back again next week.
Great.